You think the market takes your money. It doesn't. You give it away. You buy when prices are high. You sell when fear hits. And every time you call it bad luck. It's not. Most investors destroy their own money by repeating the same mistake over and over. And if you don't see it, you're probably doing it right now. Stay with me, because once you understand this, you stop losing money for reasons you never noticed. Everyone buys when it feels safe. It always starts the same way. You're not looking to gamble. You're not trying to get rich fast. You're just tired of feeling left behind. You keep hearing the same stories, people making money, portfolios going up, charts climbing every week. Everywhere you look, someone is winning. At first, you ignore it. You tell yourself you're being responsible, that you're being patient, that you're not like those people. But the market keeps going up, and the longer it does, the more uncomfortable it gets. You start checking prices more often, once a week, then every day, then multiple times a day. You don't even notice when curiosity turns into anxiety. You hear phrases like, "Everyone is making money right now. This time is different. You don't want to miss this." And slowly, something changes. It's not excitement, it's pressure. Because now it feels like not investing is the risky decision. So you start reading more, watching videos, following accounts that seem to know what they're doing. Every chart looks bullish. Every comment sounds confident. You tell yourself you're doing research. But deep down, you already know what you want to hear. Then one day, it happens. You buy. Not because you fully understand the business, not because the price makes sense to you, but because doing nothing feels worse than doing something. At first, it feels amazing. The market goes up again. Your screen turns green. Your decision feels validated. You feel smart. You think, why didn't I do this sooner? You start imagining what comes next. More gains, more confidence, maybe even freedom someday. Then, without warning, the tone changes. The market stalls. Nothing dramatic at first, just hesitation. A red day here, a flat week there. You refresh your app more often. You tell yourself it's normal, that this always happens. But then comes the headline, then another. Prices drop faster than they went up. At first, you don't panic. You remember what everyone says, just hold. So you hold. But the losses keep growing. The number you once checked proudly now makes your stomach tighten. You stop telling people about your investment. You stop opening the app in public. Then comes the night you can't sleep. You replay the moment you bought. You ask yourself, why did I enter there? You tell yourself you'll sell if it goes back up a little, just to break even, just to escape. But it doesn't. It drops again. Now the question isn't profit anymore. It's pain. Every red day feels personal. Every bounce that fails feels cruel. You start looking for answers. You read comments again, but now they sound different. Some say, buy the dip. Others say, this is just the beginning. No one agrees anymore. And that confidence you felt at the top, it's gone. You feel trapped. Selling feels like admitting you were wrong. Holding feels like watching yourself bleed slowly. So you wait and wait until one day you finally give up. You sell. Not because you're sure it's the right move, but because you can't take the stress anymore. And the moment you sell, the market stabilizes. Days later, prices start climbing again. Slowly, quietly. You watch from the outside, again. And the worst part isn't the loss. It's the thought that won't leave you alone. if I had just waited a little longer. You promise yourself something. Next time will be different. Next time you won't miss it. Next time you'll act sooner. And without realizing it, you're already setting yourself up to repeat the exact same mistake. Emotion beats logic at the worst moment. What you just saw wasn't bad luck. It wasn't timing. It wasn't the market being rigged. It wasn't that you picked the wrong stock. The problem happened before you bought. The real mistake was emotional. You didn't enter because the investment made sense. You entered because you felt late. That feeling has a name: FOMO. Fear of missing out. When prices are going up, your brain stops asking, "Is this a good price?" and starts asking, "What if I miss this?" That single shift changes everything. You stop thinking like an investor. You start thinking like someone trying to escape regret. And when that happens, logic loses. Here's why this is so dangerous. When you buy out of excitement, you don't buy with a plan. You don't know when you'll sell, why you're holding what would make you exit. So when prices fall, you have nothing to lean on. No rules, no structure, no conviction, only emotion. That's why panic hits so hard. It's not the loss that destroys you, it's the uncertainty. Your brain keeps asking, should I sell now? What if it goes lower? What if I was wrong from the start? And because you entered emotionally, you're forced to exit emotionally. This is the first self-destructive loop. You buy high, not because you're greedy, but because you're afraid of being left behind. And the market is brutal with fear. It rewards patience and punishes urgency. That's the uncomfortable truth. Most people don't lose money because they're stupid. They lose money because they enter at the moment of maximum confidence, right before reality shows up. And here's the trap. After this happens once, you don't learn discipline, you learn pain. So next time, you promise yourself, I won't be greedy, I'll be careful, I'll sell faster. Which sounds smart until fear takes over again. Because now there's a second emotional mistake waiting. Not buying too late, but selling too early. And that mistake destroys even more people. That's the next story. Fear makes people sell good assets. He didn't buy at the top. That's the important part. He did everything right. He bought solid companies, real businesses, names everyone recognized. He didn't chase hype. He didn't jump into trends. He didn't try to get rich fast. This time, he felt calm. He told himself, I'm investing for the long term. I'm not like the others. I understand how this works. And for a while, he was right. Then the market started to fall. At first, it didn't feel serious. A red day, then another, then a bad week. He wasn't worried yet. He remembered the rule. Markets go up and down. So he waited. But the red didn't stop. Every time he opened his phone, the numbers were lower. The headlines got darker. The tone changed. Correction, uncertainty, potential recession. That's when doubt started to creep in. Not panic, not yet. Just a quiet question in the back of his mind. What if this time is different? The losses kept growing. 5%, 10%, 15%. Now it hurt. Not financially, emotionally. He stopped checking prices once a day. He checked them every hour. Every small drop felt personal. And then came the noise. Friends texting, "Are you seeing this? Maybe it's time to get out." News videos playing non-stop. Experts arguing. Charts pointing down. No one had answers, only opinions. And opinions are dangerous when you're scared. At night, he couldn't sleep. His brain kept replaying the same thought. What if I lose everything? That fear is powerful. Because now the question isn't about returns. It's about survival. So he did what felt responsible. He sold, not all at once, piece by piece. First to reduce risk, then to protect what's left. Each sell felt like relief. Painful relief, but relief. At least the bleeding stopped. He told himself, I'll buy back later, when things calm down, when it feels safe again. And for a moment, it felt like the right decision. The market kept falling after he sold. He felt smart. Good thing I got out. Then, slowly, things changed. The news stopped getting worse. The drops became smaller. Some green days appeared. He noticed but didn't act. It's probably a fake recovery. Then the green days continued. Stocks he used to own started climbing, quietly, steadily. He watched from the outside, waiting for confirmation, for certainty, for permission. But certainty never came. By the time it felt safe, prices were already higher, much higher. Re-entering now felt stupid. So he didn't. He stayed in cash, watching. Months passed. The same stocks he sold in fear were now above where he originally bought them. And that's when the regret hit. Not panic, not fear, regret. He didn't lose money because the companies failed. He lost money because he couldn't sit with discomfort. He exited not because the investment was bad, but because the emotions became unbearable. And the worst part? He did exactly what he promised he wouldn't do. He sold low. Not because he was reckless, not because he was greedy, but because he wanted the fear to stop. That's the story, and it's more common than anyone admits. Panic turns temporary drops into permanent losses. What happened to him wasn't bad investing. It was bad behavior. That's the uncomfortable truth. He didn't lose because the companies were weak. He didn't lose because the strategy was wrong. He didn't lose because the market was unfair. He lost because fear took control of his decisions. When prices fall, your brain does something dangerous. It stops thinking long-term and switches to survival mode. In that mode, your brain doesn't ask, is this a good business? It asks, how do I stop the pain? And selling feels like the answer. That's why panic selling feels responsible. It feels mature. It feels smart. But it isn't logical. It's emotional. Here's the key mistake. He treated market volatility like a threat instead of a normal part of investing. The market didn't change. His time horizon did. At the moment he sold, he stopped being an investor and became a short-term decision maker. And short-term thinking is poison for long-term assets. Benjamin Graham warned about this exact behavior. He explained that prices move faster than value, much faster. But humans react faster than both. So when prices drop, people assume value disappeared. It didn't. Only confidence did. Another hidden problem made this worse. He was watching too closely. Daily prices, hourly news, constant opinions. That level of attention makes calm impossible. You cannot think clearly about long-term investments while consuming short-term noise. Fear grows faster than logic. And once fear is in control, selling feels like doing something. Doing something feels better than waiting, even if waiting is the correct move. This is why intelligent investors don't just study markets, they study themselves. Because the market doesn't force you to sell, your emotions do. And here's what makes this even more dangerous. Some people learn this lesson and still lose money anyway. Not because they panic, but because they overreact in the opposite direction. They don't sell in fear. They chase movement. They chase action. They chase the next opportunity. And that leads to a different kind of mistake, one that looks productive but quietly destroys returns. That's the third story. Chasing trends feels like progress. He was always doing something, always checking his phone, always refreshing charts, always looking for the next move. Morning, noon, night, it didn't matter. There was always something new to watch. He followed markets closely, listened to podcasts, read threads, saved articles to review later. He wasn't careless. He wasn't impulsive. At least, that's what he told himself. When prices went up fast, he paid attention. When prices slowed down, he adjusted. When something new appeared, he researched it. He believed staying active meant staying ahead. If a stock stalled, he exited. If another one looked stronger, he entered. If volatility increased, he reduced exposure. If sentiment shifted, he adapted. From the outside, it looked like control. He wasn't frozen, he wasn't stuck, he wasn't doing nothing. And doing nothing felt dangerous to him, because doing nothing looked like missing out. So he stayed in motion. Every week, a small change. Every month, a new idea. Every quarter, a different focus. Tech one year, crypto the next. Growth stocks, then value, then something safer, then something more aggressive. Each decision felt logical at the moment. He always had a reason, a chart, a headline, a macro argument, a prediction. Nothing random, nothing emotional, at least not obviously. But slowly, without realizing it, his portfolio turned into a revolving door. Money entered, money left. Positions opened, positions closed. Rarely did anything stay long, because patience felt passive, and passive felt irresponsible. While others talked about holding, he talked about optimizing. While others waited, he adjusted. While others endured boredom, he searched for opportunity. Years passed like this. Markets rose, indexes climbed, long-term investors quietly compounded, and he stayed busy, very busy. He paid a little tax here, a small fee there, a spread he barely noticed. Individually, nothing hurt, but together they added up. Not dramatically, not all at once, just enough to keep progress slow, just enough to make growth disappointing. And the worst part wasn't the numbers, it was the feeling, because he was exhausted, always thinking, always deciding, always questioning his last move. Every win felt temporary, every loss felt personal, every decision created another decision. There was no rest, no moment where the plan was simply allowed to work. When things got boring, he doubted them. When progress slowed, he replaced them. When uncertainty appeared, he reacted. He never stayed long enough to see what would have happened if he had just stopped moving. And one day, while looking back over years of statements, he noticed something unsettling. If he had done less, much less, his results would have been better. But by then, the time was gone. Not lost in one mistake, not lost in one crash. Lost slowly, in constant motion. Activity without strategy destroys returns. The problem was never intelligence. He wasn't stupid. He wasn't careless. He wasn't uninformed. The real problem was this. He believed that doing something was always safer than doing nothing. In his mind, action felt responsible. Waiting felt lazy. Holding felt risky. So every time the market moved, he felt pressure to respond. Not because the business changed, not because the fundamentals broke, but because movement itself made him uncomfortable. This is the hidden error. He confused activity with control. He believed that being busy meant being smart, that reacting meant being prepared. that constant decisions meant progress. But markets don't reward motion. They reward discipline. And discipline often looks like boredom. When you jump from idea to idea, you reset the clock every time. You restart uncertainty. You restart stress. You restart risk. Nothing compounds because nothing stays. The market didn't beat him. Fees didn't crush him. One bad decision didn't destroy him. What destroyed him was never letting time work. Every move felt small. Every decision felt justified. But together, they created friction. Friction against patience. Friction against consistency. Friction against long-term results. He wasn't losing money fast. He was losing opportunity slowly. And that's the most dangerous kind of loss, because it doesn't feel like failure. It feels like effort. Your biggest enemy is your own behavior. Here is the rule almost everyone ignores. The goal is not to make more decisions. The goal is to make fewer, better ones. Benjamin Graham was not trying to make people rich fast. He was trying to stop them from destroying themselves. That's why his rule is simple. If you don't understand what you own, you shouldn't own it. If you panic when the price moves, you own too much. If you feel pressure to act every week, your strategy is broken. Real investing is not about intelligence, it's about behavior. You don't win by predicting the market. You win by not reacting to it. The investor who survives is not the one who moves first, but the one who moves last. The solution is boring, and that's why it works. You decide in advance what you will buy, why you will buy it, under what conditions you will sell, and then you stop watching the noise. No daily reactions, no emotional trades, no chasing trends. Time does the heavy lifting, but only if you stop interrupting it. Most people don't fail because they chose the wrong investment. They fail because they couldn't stay still long enough for a good decision to work. That is the real lesson of the intelligent investor. And once you understand that, the market stops feeling dangerous. Because the biggest risk was never the market, it was you. Control yourself, or the market will. Most investors don't lose money because of the market. They lose it because they can't control themselves. They react, they panic, they chase. If this felt uncomfortable, that's the point. Because investing isn't about being smart. It's about staying calm when everyone else isn't. The market will move again. Fear will return. So will greed. The only question is this: will you react, or will you stay disciplined? That choice, more than any strategy, decides who wins in the long run. This content is for educational and informational purposes only. It does not constitute financial advice. Consult a professional before making financial decisions.